Once more, the Fed's apparent success in lowering the rate of inflation is lulling investors into a false sense of security. You may recall that when the CPI for October was released and it came in lower than expected, it prompted a significant stock market rise. The same thing happened, at least initially, when the producer price release was made, and it again came in lower than expected. However, even lower inflation is preferred. Following a 0.4% increase the month before, a 0.5% increase in producer prices was anticipated for the entire month. Instead, there was only a 1.2% increase. In addition to falling short of the majority projection, this outcome also fell short of the low and high ends of the anticipated range, which was between a low and high of 0.3 and 0.5 respectively. The year-over-year number also came in lower than expected, as you might expect. The month prior, it was 8.5%. Even though a drop to 8.3 was predicted, we actually dropped all the way to 8.0, matching the low end of the range. If you take away food and energy, the so-called core, they were aiming for a climb to 0.4, which would have been a little hotter than the 0.3 from the previous month. The consensus prediction was for an increase of 0.2 to 0.4, which is significantly below the low end of that range. Instead, we got zero, knowing Chris at all, as Joe Biden would put it, no inflation, and the end of inflation. Again, the year-over core was expected to increase by 7.2, matching the increase from the previous month's 7.2. Instead, it went up just 6.7%. When you factor out food, energy, and trade services, the increase is even smaller than what was anticipated. Additionally, the rate fell from 5.6% to 5.4% year over year. All of these figures are still impressive, of course, with the exception of the mouth-over-mouth change in food and energy, which was unchanged. Even while these figures appear to indicate that the inflation problem is abating, a quick look at the rises reveals that we still have a serious inflation issue. It's not. However, the markets are focusing on this information. This instantaneous response caused the S&P futures to increase. In fact, by the time the markets opened for business, the Dow had increased by 450 points. Even yet, the Dow ultimately gave up the whole rise. Before closing with a gain of roughly 56 points, I believe it may have briefly gone down a couple hundred points. The Nasdaq, though, had a greater increase. It increased 1.27%. The S&P 500 increased by about 0.9%, and the Russell 20 increased by 1.5%. As a result, the majority of the index still reaps the benefits of the purported decline in inflation. And once more, all of this is anticipated to give the Fed cover to at least partially change course. When the dollar fell to that level, it had lost 8% of its value from its peak, which was reached 8 weeks earlier. It is a significant decline. The irony of this situation is as follows. The Federal Reserve appears to be making work on bringing inflation back down. The more, the US dollar is less strong, because they had to deal with the consequences of their own inflation as well as the weaker euro relative to the dollar. The rise in consumer prices there was being exacerbated by the weakness of the common currency. Now that the situation has changed and the currency is weakening, we'll need to eat our own medicine. We will begin to notice this impacting our customer pricing, albeit not right away. The weaker currency will eventually start to translate into higher consumer costs, perhaps in early to mid-2023, though there may be a slight lag. First off, we would now have to pay much more to import those goods. It will immediately increase our import expense. The cost of shipping such goods to the United States will also go up as a result of the weaker dollar, which will result in higher fuel prices as well as other transportation charges. Naturally, all of this has negative effects on the GDP of the United States. Keep in mind that the fact that the trade deficit was significantly lower than it otherwise would have been was the only factor in the third quarter's positive GDP growth. And one of the key causes of that was the dollar's strength, which reduced the price of our imports. The Strategic Petroleum Reserve allowed us to export all of that oil, of course. When the dollar truly starts to fall, the tendency towards cheaper imports is reversed. GDP will fall as a result of the excessive costs we'll have to pay for those goods. However, the economy will experience greater downward pressure as a result of the pressure on consumer prices to rise. The amount of household debt is at a recorded high of $16.5 trillion, a climb by 1.7 trillion in the previous year. Again, increasing household debt is not a sign of affluence. It does not imply a booming economy. If our economy were strong enough to handle the enormous demand, consumers would be forced to use their credit cards to pay for their purchases. They would buy things with the money they make from there. Consumers cannot afford the purchases they are buying, as shown by the fact that they must take on debt to do so. Now, I think one of the reasons individuals get into debt is to buy the food they need to eat, and the only way they can generate money is by charging for it. So the economy is not robust. Again, used car values are declining, not at all like deflation. This does not imply that the Fed is succeeding in containing inflation, as even while the price of a home is declining, the cost of ownership is still rising. Similarly, although the value of a used automobile is decreasing, the price for an American to purchase one is still rising. However, another crucial point regarding the rise in household debt that is not being discussed is how it demonstrates that the Federal Reserve is failing in its efforts to combat inflation. This is because if consumers continue to incur more debt in order to purchase goods, prices will continue to rise because there is still a demand for them. What happens if we don't increase savings and cut back on consumption. As a result, prices are less subject to demand pressure, but higher savings also translate into more investment money being made available to boost supply. If people aren't consuming, they are saving. Their savings may be put to use buying equipment for factories that will boost supply in the future, and this is what drives down costs. More availability than demand. This method can be used to combat inflation. Demand has not reduced, and credit has not diminished, so the current scenario is different. Sadly, a lot of people are talked into buying whole life insurance when they really only need term. The ability to pay a modest premium with term life insurance is the reason for this as well. As a result, you have more money to invest in opportunities that might yield greater returns than those provided by a full life insurance policy. Furthermore, life insurance is not always necessary. You only need it while your loved ones are still financially dependent on you. You can take advantage of the lowest premiums while still providing your family with the biggest death benefit during the years when they will need the money the most, thanks to the insurance's totally digital nature. When you apply for coverage of up to $3 million, there are no physicians, no needles, and no paperwork to fill out. A phone, a laptop, and a few extra minutes are all you require. You'll be able to tell immediately if you've been accepted because intelligent algorithms work in real time. There are no additional fees, and you may cancel during the first 30 days and get a full refund. You can withdraw consent at any time, but enough about government's lies on inflation. Simply put, because it presumably had the most leverage and the lowest real value, cryptocurrencies were the weakest link in the chain. Naturally, the bankruptcy of FTX has had a negative impact on many of these associated businesses. About a year ago today, Bitcoin hit a record high of 69,000, and there are about 16,800 as I speak. So, a decline that, at its lowest, was about 75%. I believe the decline was to be less than 77%, but the FCX crash confirms exactly what I said in the moment. The rally was a fraud. Bitcoin and other cryptocurrencies were pumped before being sold using the entire sum of money used to purchase them. But now that we know where the money came from, we can support it. Everyone should sell their gold and buy Bitcoin because it was created with the help of customers whose money was stolen. Gold had no value. It was lost. Bitcoin, the new gold, it never stops making absurd claims. Subprime loans and the housing market behaved exactly as I had predicted they would. Michael Saylor could not have been more wrong, as the opposite of what he prophesied had already happened. When I delivered my address to the mortgage lenders, I predicted a big decrease in real estate values, and my forecast came true. The subprime mortgage bubble I anticipated, as well as a financial catastrophe, definitely happened. But what has happened to the price of Bitcoin since Michael Saylor suggested to conference participants to sell their gold and buy Bitcoin on the day of his lecture, when Bitcoin was trading more than $60,000 per coin? Right now, it costs 73% less. However, the price of the gold that he urged everyone to sell is only down by 4%. Of course, that is expressed in terms of US dollar instead of every other currency in existence. Gold has become more expensive. As a result, the euro, Japanese yen, or British pound are frequently used as units of measurement by conference goers in Dubai. Everyone who used their dollars, pounds, or euros at that conference a year ago and converted them into gold is therefore significantly better off. However, because Bitcoin lost a lot more value than any other currency during that year, anyone who thought Bitcoin using any other currency is in a much worse position than they were. There will be genuine cryptocurrencies backed by actual currency, just like paper money, gold. Money used to be issued by private banks because it was backed by gold. The future will witness more of the same. In actuality, it is taking place right now. Private businesses will produce digital currency backed by real money gold, but it will function much more effectively now than it did back in the 19th century. Because the internet and blockchain are available, we can greatly increase the portability and dilution of gold. Gold is currently a far more advantageous kind of currency. Blockchain did not cause the demise of gold, but rather its insurgence.